In this method, we try to understand the valuation based on PV factor. Last session, I explained you the PV factor. So this session, we are going to explore how NPV is different and how it is more effective. So what is net present value? The future outflow of cash, which I'm going to receive after 2 years, 3 years, or 5 years, or 10 years. The value of that outflow is not same. The value of that outflow is always going to be decreased. And why? Because I am giving up the current consumption of that particular things and I'm using it in future. So the value will be down. So let me explain. I'll take an example with Excel. Suppose these are the years and this is my income. So in year one, I receive 500, but from year two onwards, this income is in future. So what is the value of 6,000 which I get in 10th year? I need to find out. So I need to find out their present value. So there is a formula for present value. So let's work out first. Present value is equal to 1 divided by 1 plus R divided by 100 and bracket raised to T. So this is a formula available where R is the rate of interest and T is a period. So if I assume 10%, then in that case, year 1, 2, 3, 4, 5, 6, 7, 8, 9, and 10. So the values we will calculate is 10 divided by 100. For year 1, it is 0.1. So my present value factor will be 1 divided by 1 divided by, so it is, sorry, then here it will be equal to 1 plus R and my PV factor will be is equal to 1 divided by 1.1. It is, so for second year, if I calculate, it is 1.1 into 1.1. For third year, it is 1.1 into For fourth year, 1.1 into, for fifth year, 1.1 into, for sixth year, it is equal to 1.1 into, for seven, it is equal to 1.1 into, for eighth year, it is 1.1 into, for ninth year, it is 1.1 into, and for 10th year, it is 1.1 into. So this I get a percentage value. So this value is nothing but 1 plus R divided by 100, and power is to T. So I have this value. Now what I'll do, I'll just divide this value to 1. So 1 divided by this value. So I'll get this answers. Now I have income. I will add PV value. So I'll just copy paste these values. Then I get NPV. So how I get income? NPV is nothing but PV factor into income. So this will be equal to this into income. So if I club together, I'll find out what is my income. So my total income is 13,385.65. So if I consider the 10,000 which, sorry, 6,000 which I received in 10th year, actually its value is only 2,300. So considering this, I have to understand the present value and its relevance. Because even though I claim 2,000 I received after 5 years, but the value of 2,000 is actually only 1,200. The value of 500 is 455 and so on. So because I applied time value at 10%, the values are going to change. So NPV is difference between the present value of cash flow and future cash flow outflow. So it analyze what is the value that is associated with the things. So here we are measuring the value indicator of future income in present system. This method is applicable and beneficial to understand that whatever future income I'm receiving, what is its value now. Because after 10 years, if I receive 6,000, the value of 6,000 will not be seen. The value of 6,000 will be reduced and it is 2,000. So, understanding this concept will help us to find out what is the future value, and based on that, we can take in considerations the meaning, concept, and importance of time value regarding income. Why it is important? It helps for comparison on real ways because as per this method, you can understand what is the income available or possible. You can just evaluate the flow of income in exact way, and you can calculate what is the real value of future earning. If I claim that you give me 1,000 now, and after 10 years I'll give you 6,000. So value of that 6,000 is only 2,000 because the time factor is applied. This method is used for budgeting decisions, investment plannings, business valuation, merger and acquisition, real estate development, pricing decisions, and so on. So this method is used for valuation under different circumstances and methodologies. Now, we already discussed this formula. NPV is equal to cash flow divided by 1 plus T minus initial investment. So here, when I calculated actually 13,000, and if suppose my initial investment is 5,000, then 13,000 minus 5,000 will be my value of investment. So this is the formula RT divided by 1 plus I into T. Now here I mean discount rate. So when it is given 10%, it is 10 by 100. And if it is only given 0.10, we'll take as only 0.10. So we already explained discount rate, so I'll just keep the part and go ahead. Let's value the manufacturing company's investment. Initial investment is 5 lakhs and expected returns 1, 2, 3 are 2 lakh 10,000, 2 lakh 37, 2 lakh 65,000. Discount rate is 6%. Now, when discount rate is 6%, it means the company is able to generate the income which will applicable the time value of 6%. So we have cash flow into P factors. Now these P factors I already showed the method. So what I get is year one, it is 2 lakh 10,000, but when I apply present value, it's 1 lakh 97,000. Year two, it is 2 lakh 10,000. Year three, it is 2 lakh 22,000. So considering this, if I add all this together, what I'll find my total value is 1 lakh 31,500 and my initial investment is 5 lakhs. So it means if I adjust my initial investment, I'm able to get 1 lakh 31,000 as a return. So this is investment generation on 6%. If it is 10%, 20%, 30%, the investment generation will change. So this is all about net present value. Now let us get back to a complete numerical. So we'll again go back to our numerical where I illustrate a full numerical. Let's take an example. Investment is 50,000. Now year and income. So we're taking first, second, third. 4, 5, 6, and 7 years. Income is 18,000, 25,000, 38,000. We'll reduce here 12,000, 18,000, 21,000, 23,000, 23,000, 25,000, 26,000. So this is my income which I receive. I take investment as 60,000 for calculation purpose. Now, this investment is for 7 years. My depreciation of this capital asset is at, I need to calculate. So if I'm going to use the asset for 7 years, then first thing I will calculate depreciation. So what is the formula for depreciation? Depreciation is equal to investment minus scrap value divided by duration. So in this case, my investment is 60,000. Scrap value is not given. So I assume scrap value is 0. So for depreciation, it is 60,000 divided by 7. So my depreciation is 8,000. So I'll make it round figure, 8,571. So each year I'm charging this depreciation. Now for our convenience, we'll assume the PV factor, that is capital rate, is 10%. Because we already calculate 10%, I don't want to waste the time on again calculations. So this is numerical, and I'm trying to find out whether the investment is good or bad. Okay, for our convenience, what I'll do, I'll take it income from A, I'll take it other income from B. So let's take it as 10,000, 13,000, 16,000, 21,000, 55,000, 30,000, and 34,000. So we have two projects. We have depreciation, and we need to find out which is good. So let's work out for the income one. So when I find any income, depreciation is my expenditure. So in first step, what I'll do is I will copy and paste depreciation values. So then I'll find income after depreciation. So suppose I consider this column as A and this column as B, then here will be A minus B. So what is the income after depreciation? 12,000 minus depreciation, and find out for 7 years. Then I have to apply PV factor at 10%. So let's go to the previous sheet. We'll take the direct values 1 year, 2 year, 3, 4, 5, 6, and 7. So what is the now income after P factor? So what I'll do, suppose this is a column C and this is column D. This is column D. So income after P factor is C into D. So let's find out this into income after depreciation, and I will calculate for 7 years. But please remember, as per provisions of capital budgeting, the depreciation is only adjustment I am making. It is not actual expenses. So as per capital budgeting, the part of depreciation is hidden adjustment for my income. So after applying P factor, I will again have net income after PV. So here I need to add back depreciation. So for this, what I'll do is, suppose this is column E, then here E will be plus B. That is income after P factor plus depreciation, and I'll calculate the values. Once I find, now this is my income each year. So I have to make the total. My total income from project A is something 1,17,277. So this is total. Then what is my investment? It is 60,000. Then I have to find out my NPV. So out it is equal to outflow outflow minus investment. So for project A, if I make a choice, I'm getting answer this. Now let's work out for project B. To save the time, I copied everything. Here, what I need to change, this income of B. So let's copy the income of B. In this case, the depreciation, the P factor, these two will remain same. So the depreciation, the P factor, these values will remain same. There will be no change. But what changed is income after depreciation and net present value. Now, if I take the total here, it is 11 lakh, sorry, 1 lakh 14,374.35. So, if I deduct initial investment, what I find income of B is 54,374, whereas income of A is 57,277. So, it means project A is giving better output. So, if I compare A with B, the calculation part remains same. The calculation part remains same. If I find then the investment of this A is more compared to investment return of B because I am getting 57,000 in project A and project B I'm getting 54,000. So if I want to choose at the rate of 10%, then I need to find out that project A has better returns and it will be more profitable. So what is the first better returns? So project A minus project B. So project A has more returns of 2,903. So if I see the cash flow and make a total here, it shows that project B is generating more income because it is generating 1,49,000. But when I calculate the present value, I find the project A is a better approach because it is giving the better values. Where I consider project B, it is not giving that income because it is short by 2,903.54. So when I want to take a call whether I select project A or shall I select the project B, I should conclude that I should go with project A because it's more profitable because after deducting initial investment, the value of project A is more by 2,903.54. Any doubt so far? You can just post in WhatsApp, sorry, in chat box, or you can ask. I'll wait for 2 minutes. Anybody has any doubt? Now, let's understand the. I'm here not able to give the full-fledged numerical solution like payback period, IRR, then profit index, and NPV together because in Excel showing everything together will make you confused. So I solve all these numericals separately. In examination, it might possible that they will combine two methods or three methods together, and after combining, they will take a call. So In examination, it is expected that from following, find out which project to be selected and why. You are equal to calculate payback method, internal rate of return, and NPV. So if I take about project B and analyze it, I'll find out the income is 1,49,000, but income generated grand is 89,000. So considering this, the flow of income I need to map and I can find out profit and loss. So this is the advanced analysis. So anything I need to re-explain? Any doubt? Please remember when you solve the numerical of capital budgeting, always you should have two decimals. That is, here if you can see 57,277.89. That two decimals indicate money. Sorry, paisa. So now let's begin to the next chapter. Now we have seen the two projects are there. So we can compare project A with project B and decide which is possible and which is not possible. But in case if I want to select both the projects, what to do? So let's discuss about the same. So the discussion starts about rationing and project selection. What is in by rationing? If I have limited resources available and I need to choose more than one option for my investment, then I will take a call based on different parameters whether I should invest in one, two, or three, or I should have a combination. If I want a combination, then how much should be in A, how much should be in B, and how much should be C? In scarce resources, I'm planning and progressing my business. So when I'm progressing my business, I need to understand how I can progress in real world conditions. Because if I give up A for B or I select B or A, in either case, I'm going to not select the other opportunity. But if I have some capital extended and I can invest in both the options, then there is no competition and I will have a scope of investment. So companies face profitable when they go with the multiple projects and they go with the rationing of projects. And that's why we need to understand the rationing of capital projects. In rationing, literally, suppose in a family, there are five people and only one piece of bread is available. What we do is we cut that piece and give it a small portion as per the age and physics of that person. In business also, when I have capital available, I want to select the opportunities. I will make prioritization based on wealth maximization and returns and select where to invest, how to invest, and why to invest. There are two type of rationing. One is hard and second is soft. Now, what is the hard rationing and what is soft rationing? In case of hard rationing, I will find weighted cost of capital and strictly as per the weightage, I will assign the value. So here I will apply the proportionate wealth creation and only that value I will just apply. But in case of soft rationing, I will understand the profitability capacity beyond the weighted cost of capital. It means now it might look that project is not working good, but it might possible this project will generate the future income more better way. So in that case, I need to understand the value and I will do the reasoning based on need and situation. So there is two type of reasoning, hard and soft. Hard reasoning is strictly based on outcome of weighted cost of capital. That is how much is weight. For example, if weighted cost of capital project is 30%, B is 70%, then out of 100, 30% is given to A and 70% is given to B. But in case soft capital rationing, suppose now the project is doing well, so I'll give 50% to project A and 50% to B. If project A is doing more well, then I'll assign 70% to A instead of 30%. But after 6 months, I find the project B is doing good, then I will change project B. So in soft rationing, I can allocate the fund or I can change the percentage of allocation based on profitability and returns. So in real world, what we do is we first analyze the profitability. We will understand how much returns are generated. Based on profitability and returns are generated, we will understand the wealth creation impact. After analyzing the wealth creation impact, what we can do is we can evaluate and set the ranking of projects. Suppose project A first rank, project B second rank, project C third rank, and so on. Then we have to find out the proportion or comparative returns. For example, A is 10% profit, B is 5% profit. So if I want to divide the ratio, it is 2 as to 1. And then I will divide my capital in 2 as to 1 and select both the projects. So this is actually a ratio. While rationing, I will take care the project which has maximum net present value and less trade payoffs and balanced return strategy. Now, why I prioritize net present value? Because this concept of valuation, that is net present value, will give me an idea that what is current price of future outflow. And based on that, I can take a call which is good, which is bad, and how. So considering the same, I need to allocate resources where maximum net present value is available. If I find the net present value after certain period is changing, then I will change the allocation as a soft capital rationing, and there I apply strategy of balanced return and soft rationing so that my allocation is in more profitable way. Now, when I do the ranking, I can use various alternate methods. First, I'll go with the profitable index. The first, why I select profitable index? Because profitable index give me what is a percentage of returns or value created. So it is a tool where I'm ignoring the duration, I'm ignoring the depreciation, I'm ignoring inflation. I'm only considering what is income generated, what is my investment, and I'll compare both the things. So first I will find out profit index. Then by using advanced optimization techniques, I will allocate the funds across the available projects to maximize my overall portfolio returns. After this, I will do strategic alignment of prioritizing which project to be select and why. So based on profit index, the and NP values, I will do the programming and allocate the funds. And after that, I will start analyzing which project doing good, which project is doing bad, and why. And this way, I can select my project. For example, VV construction project want to rank the projects. Then what you will do? The first thing they will calculate the profitable index, that is net present value divided by investment. Second, they will decide the priority that how much capital for project one, two, three, four, and 5, and then they will check the decision after each financial year and revise it. And this way, they can avoid the loss and keep their investment in most profitable way. If I do proper capital allocation and rationing, this will mitigate my loss and the maximum advantage of risk can be enjoyed because risk and profit they go together. If I'm maximizing my risk, I'm taking benefit of more profitably. So in this case, I'm taking market at the risk and I'll be the first person of to move forward in this domain. Please remember, as per theories of profit, if I'm having something which other person don't have, I can earn the profit. Or if I have something which is more comfortable or which is more cost effective than other person, then I'm earning profit. And third, if I have something innovation, then I'm earning the profits. So in all these three domains, I need to first understand market risk and invest in venture capitals. So that venture capital allocation, if I do it properly based on property index and in profitable index, if I analyze the returns based on the kind of income generated, then my capital rationing will work very well. Now, what are strategies for rationing? Focus on shorter payback. So first concentrate on a project which will give your payback period very less. Don't target on higher range because time value of money will be applied. If I select the shorter projects, it will generate the revenue and I can reinvest in other source and that will help me. But if I invest for the longer duration projects, the value creation will take a longer place and the benefits will not be achieved for me. So I need to focus on short duration and higher returns. Second, give preference to the small and less market exposures because if I take small steps, it will more accumulated and the risk if I'm fail or if market become negative, the loss will be less. Utilization of joint ventures and alternative finance to share the investment risk. So do the rationing in maximum capital, understand shorter paybacks is more important, and give favor to the less market risk but higher returns. And considering this, Change your utilization based on periodical changes on revenue generation from capitals. So let's now understand the next part, that is managing risk and uncertainty. For any issue, we cannot give up the concept of risk. For every decision, it will be associated. But the only concern, I need to reduce the impact of risk or I need to reduce the weightage of risk. So in case of risk management, I need to concentrate over financial complexity and understand how I can nullify. So what are the steps? First step, I should not invest. But when not investing, it will not give me any value. So for managing uncertainty and risk, what I need to stack the financial approach. I need to have financial analysis and alternative source of finance. So I whenever take any investment decision, financial decision, or any fire, buy, sale, or purchase decision, I need to find out what are different opportunities and their cost. I need to do analysis about returns, payback methods, and property index. Based on this, I have to rank the projects which are good for me and which are not good. Then I have to find if I'm selecting these projects, what are alternative source of finance are available. Considering the alternatives available, my vision, mission, and approach, I need to rank the projects. When I rank the projects, then I need to find out which is the best and which is the least. So considering best project, I will do investment in that project. Now let's talk about how I can correlate my investment capital risking with corporate strategy. Any business want a development in three levels: vertical invest development, forward development, and backward development. The vertical development always talks about increasing the size of firm, where I will grow in numbers, I will grow in output capacity, I will grow in volume of my product. The forward growth talks about future expansion. For example, it is might possible that I'm producing tire, so tire is utilized in cars. So I will go for production of cars. So when I'm doing forward integration, it is extension of my product to the another final product. When I do backward integration, I'm going back. For example, if I'm producing tire, I'll go for the rubber plantation because that is my source of raw material. So I'm doing backward integration. So if I want to focus on expansion or strategic decision regarding investment or forward, backward, or vertical, it helped me to understand how much is profitability and where it is. It understand to focus on key issues and it helped me to narrate where the investments will generate more returns. Secondly, if I'm able to take quick decisions on effective analytics, it will always give a favorable financial position. And this kind of position is always an welcome approach because this will help me to get better profitability and wealth creation. So if I have planned properly and I'm able to generate the returns in proper way, then I will be a financial discipline and I will avoid the burden on my financial liquidity and overall health of organization. So when the capital listening is done and I'm strategically understanding the risk and the aligned profit, so I'm creating competitive edge with strategic balance that will help me not to lock the funds in unnecessary investments and not to over or short investments when opportunity is available. So in summary, capital rationing is a strategic tool where I need to find out investment priorities. I need to focus on wealth creation and for majorly on long run. I will break down my long term goals in short run and I will decide where to invest, how to invest, and how much to invest, so that every single rupee invested will generate and revenue, which is profitable to my side. So in capital reasoning, the choice about the project selection is made. The choice about analyzing the different tools like payback method, internal rate of return, then profitable index, NPV, is considered together to make sure the amount invested in capital will be generating revenue. So this is all about capital and NP valuation. Anybody has doubt, they can put in chat box. Anybody any doubt? We have covered the third unit where we have talked about net present value, internal rate of return, capital index model, risk and under risk and decision under risk. Then we talk about capital raising and project selection. Now the last part of unit 3 is role of qualitative factors in project selection. Now up to now we have seen the quantitative factors like what is the profit index, what is net present value, how much is my revenue, how much is future income, and so on. But there are certain qualitative factors which are also beyond financial numbers to make a call when I'm taking a decision about whether I should invest or not. So these factors are called as a qualitative factors. The quantitative factors are the numbers, whereas the qualitative factors are emotions, or we can say qualitative factors are implications, decision impacts, what we are expecting for say. For example, if I have two companies, company A and company B, then in this case, if I find company A is not making profit, B is making profit. So I if close the company A, then I may be in profit, but on longer duration, I can see I'm missing opportunity of one product. So that one product might cost me later in long term. So while making decisions, I need to understand the profitability and the benefits on quantitative as well as qualitative domains. And for that, I need to understand what are different qualitative factors and how they make an impact or investment decisions. So, in qualitative factor decision, I will take a call that whether the investments, their alternatives, and their future cash generations are correlative. If there is a variation or change, then in that case, the qualitative analysis will make a helpful hand for taking calls. Now, when I say qualitative factors, these are mostly strategic factors and they are basically do not involve a direct financial decision, but they are supplement. In case of quantitative factors, these always guide yes or no. But in case of qualitative factors, they never disclose the confirmation that yeah, either one or two. They always give a round idea that whether I should select one or I should select two. So let me share the PPT for you. Why project selection matters? Because if I'm have wrong selection, it will increase my cost, it will be wastage of my times, and it will focus on wastage of resource allocation. So most of times, 70% of project fails if my selection is poor. So there are certain factors, as I said, beyond numbers, which need to take in consideration. And these factors, like market risk, competitive dynamics, government instructions, the taste and preferences, I need to consider while taking decision. Every project selection has two factors. One is a quantitative and other is a qualitative. The quantitative factors are derived and give the output values understanding the project, whereas qualitative factors will give an idea whether that project's quantitative outcomes are being exact correlate to my ideas or not. Then what are qualitative factors? The first factor is stakeholder impact, that is customers, employees, government, and social, whether they are happy, not happy, what are their emotions, what are their preferences, that will make an impact. Second, market risks, technological changes, and regulatory shifts that will again make an impact. Then strategic alignment, that is joint ventures, mergers, takeover, new firms, and so on. This will also create an impact over my investment decisions. So these are the three main division of qualitative factors. First, strategic alignment and ventures. Second, risk assessment from market, technology, and regulatory. Then, preferences and choice of shareholders. Strategic alignment is always a key area. For example, Tesla started first electric product, which was denied that it will explode and so on. So people was not ready to accept it. But later on, when the company focused on advertisement and safety issues, the people start giving preference to the project. So this is one of the quality factors first impacted and how the Tesla overcome to that. Now we'll talk about market volatility, its economic fluctuations and demands beyond the quantity numbers, which is impact of perceptions and preferences of buyers. Whereas technical changes we mostly see in case of IT industries, where the more and more good technology will reduce your cost and will have shorter production cycles, making it more and more productions coming out at a cost effective way. If regulatory shifts are in favorable position, that will give a better pricing approach because the regulations will have less licenses and more aggressive pricing, and that will create more wealth. So I can get more profitability. Then what about the stakeholder impact and social responsibility? In case of stakeholders, employee and customers, or suppliers and purchasers, I need to understand their technological preferences, their financial positions, their workforce combination, and it will help me to get the benefit. When I'm doing quality project selection, first I need to use the scared crow method. As per this scared crow method, I need to first be a whistleblower and understand the financial risk involved. I will first understand impact over the psychology and emotions or cultural beliefs of the people, and I will find out the easiness or comfort of my product launch and services. In Delphic method, I'll go with the linear programming where I will visualize the minimization of bias so that my product is more suitably productive. And the last, I will do the weight scoring based on qualitative and quantitative factors together. And if maximum score is gained, then I will select that product. So in qualitative, I will do strategic analysis, that is market, percent of change, alliances, future companies, and so on. In financial ROI, I will calculate quantitative factors. In risk assessment, I'll do both qualitative and quantitative. And then again, I compare stakeholder impact. So comparing all these, I will make a decision, and that will be complete decision based on qualitative and quantitative. So it's 8 o'clock. We will discuss this in coming next session. And till date, we have finished the 3 chapters. Now we are moving further for the fifth chapter instead of fourth chapter. And after fifth chapter, that is dividend policy, I will again come back to the working capital management. So now today is 12. By 20th, we are expecting to finish our syllabus. So after that, I will share the videos of numerical solves and you can just go through that. If in doubt, you can ask me. So we'll stop for the day and we'll meet in next session.